Hello, thank you for joining us. I'm with Patrick Moriarty of Moriarty Financial Services. And Patrick, in this series, we're talking about the 7 financial blind spots.
Right.
Thank you in advance for sharing your wealth of knowledge with us. There's just so much information, and retirement can sound complicated or intimidating, but
sure.
You're here to clear all that up for us. Now, today we're going to talk about a really hot topic, inflation.
Correct, yeah. I mean, ever since COVID hit, right, inflation is top of mind for everybody. It's affecting everyone, from the things we buy in the grocery stores, to automobiles, to cars, to real estate, you name it, everything's gone up.
Yeah.
And so inflation is really top of mind, but what people don't realize is that over a long period of time, 15, 20, maybe 30 years in retirement, even a small level of inflation can really impact your retirement over a long period of time. It's important that you factor that into the planning process a little bit each year. A lot of prices don't go down. We don't see the price of eggs go down. We don't see the price of automobiles go down. They only go up. So to have a successful plan, you have to have that factored into the planning process.
So if you've already had a plan in place pre-pandemic, you should come in and almost tweak it to adjust.
Oh, no doubt about it. You have to make adjustments. You have to account for it on a year-by-year basis. See, inflation is known as the silent killer because it eats at your spending power a little bit every year.
Right.
And so an example of this, on how it can really affect your retirement over, let's say, 20 or 24 years, is taking a look at someone who's 65 years old, all right, and they're retired. Let's say they want to spend $7,000 a month in retirement. We have to factor in, let's say, a 3% inflation rate on that spending each and every year for 24 years.
Right.
That puts the individual at 89 years old. So at a 3% inflation rate over 24 years, that $7,000 of goods and services will cost $14,000 per year to buy those same goods.
Wow.
So it doubles. A 3% inflation rate will double your cost of living over 24 years. And that's why it has to be part of the planning process. We can't spend the same amount of money each and every year because it's not realistic. We'll be buying less goods and services with that $7,000.
Right, but we still need what we need. So how do we protect ourselves against this?
Well, we have to make sure that we have an investment portfolio that will offset inflation and taxes, meaning we have to have some of our money outpacing that, and the way to do that is with some of your money in the growth portfolio, right? Stocks, bonds, mutual funds, ETFs. Those are the types of assets that can outpace inflation. But the more important thing is that within your plan, that you have an adjustment each and every year for a rate of inflation.
Yeah, and I know you mentioned in our last show how many folks don't even have a plan.
That's right.
So now factoring this last few years of inflation, if someone hasn't gotten the ball rolling, it's really time to now.
Of course, and again, it's a blind spot. It's something that people don't think about as far as what that impact could be on their retirement over a long period of time. So it's important to have a plan and factor in some sort of inflation rate.
All right. Now, how can folks get a hold of you, Patrick?
Well, they can contact us, and we'd be more than happy to sit down and start the planning process and make sure that there is an inflation rate based into your retirement planning process.
All right. Thank you so much, and thank you for joining us. We will see you next time.